Hello everyone. Today my team and I will be presenting the Going Green case. I'll begin by walking you through the GRI standards framework, giving you an overview of how organizations report using the standards and the AICPA attestation standards. My teammates will be then continuing with the remaining sections of our analysis for this case. The GRI standards, this provides a global framework for transparent sustainability reporting. There are three main components in this form of reporting includes universal, sector, and topic standards. This level of reporting helps the stakeholders make a very well informed judgments about the organization's performance and its contribution to sustainable development. To report in accordance with the GRI standards, the organization must meet all 9 requirements as mentioned here. The first requirement being to apply all the reporting principles. The reporting principles include accuracy, balance, clarity, comparability, verifiability, timeliness, sustainability context, and completeness. The second requirement is to report the disclosures in general disclosures to. This includes information about the organization structure, the entities included in the organization sustainability reporting, the reporting period, how it performs, how it reports what it does, and how it engages with the stakeholders. The third requirement is to determine the material topics using the GRI sector standards, which includes reviewing the sector topics, deciding which ones are material, and listing them in the GRI content index. Requirement 4 is to report the materiality process using the disclosures, list the material topics, and also explain how each topic is managed. The fifth requirement is to select the relevant disclosures from the GRI topic standards for each material topic, and only the disclosures that relate to the organization's actual impact will be disclosed. The sixth requirement, note any omissions in the GRI content index were allowed, clearly stating which part was omitted and why. It is important to mention why it was omitted as well. The seventh requirement is to include a full GRI content index which shows the standards used, all the material topics, and where each required disclosure appears. The eighth requirement is to add a statement of use, naming the organization, and also to specify the reporting period. For example, company ABC, they can say the ABC Limited reported in accordance with the GRI standards for the period 1st of January to 31st of December 2024. Finally, it is important to notify the GRI by email that the organization has used the standards and also included the statement of use as mentioned above. If even one of these requirements isn't met, the organization cannot claim that it has reported in accordance with the GRI standards. Moving on to in accordance versus with reference, there's 2 ways to use the GRI standards. The organizations, they can issue a full sustainability report in accordance with the GRI standards, or they can use selected standards or disclosures with reference to the GRI framework. In accordance reporting includes it must meet all the requirements in GRI 1, and it also provides a complete view of the economic, the environmental, and the social impact as well. This requires a full GRI content index with all required disclosures, whereas with reference reporting, it only uses a partial use of the standards. The content index is shorter. It's six sections instead of 12. And the statement of use must also explicitly say that it was done with reference to the GRI standards. Both still require notifying the GRI via email, and they also both require the statement of use as well. With reference reporting, it provides transparency, but it at a lower level of completeness than in accordance. Moving on to the general disclosures, the GR2 includes 5 sections that provide background information about the organization and helps the readers understand its overall sustainability context. The first section is section 1, which covers the basic organization details, who the organization is, how it prepares its sustainability report, and which entities are included in this. Section 2 basically gives an overview of the organization's activities, its employees, and other workers involved in the operations. Section 3 focuses on governance, describing the leadership structure, the roles, the expertise, and how the governance bodies are compensated. Section 4 explains the organization's strategy, policy, and practices for sustainability and responsible conduct of the business. And Section 5, it outlines how the organization engages with its stakeholders, including its practices around employee representations and collective bargaining. Moving on to the external assurance requirements, moving on to the GRI topic standards. The topic-specific GRI standards are grouped into three major categories. First being economic standards, which mainly focuses on how the organization creates and distributes economic value and the financial risks and impacts linked to its activities. The second being the environmental standards, which mainly looks at how the organization uses the natural resources and its overall environmental footprint. Lastly, the social standards addresses the organization's impacts on people, including the employees, customers, and the locals. Together, these standards they will ensure a clear, consistent, and comprehensive view of an organization's sustainability impacts. Finally, on to the GRI external assurance requirements. It outlines 7 key elements needed to assure a sustainability report. First, the assurance provider must be fully independent, so their conclusions are unbiased. They must also be qualified to issue an assurance statement. Strong quality control procedures are necessary, and this must guide the engagement to maintain consistency. The assurance process must be systematic, documented, and also evidence-based. The provider must assess whether the report is fair, balanced, and accurate, including how information was selected. They must also evaluate how well the organization has applied the GRI standards, including how the information was selected. They must also evaluate how well the organization has applied the GRI standards in its reporting, whether the report is fair, balanced, and accurate, and also they must publish an assurance statement explaining their conclusions, roles, and the work performed. These elements will collectively strengthen the trust and give the stakeholders confidence in the report's reliability. Moving on to the AICP attestation standards, there's 3 engagement types. The first one being an examination, which provides reasonable assurance, similar to an audit, and it also results in a clear positive conclusion. A review, it provides limited assurance using fewer procedures leading to a negative form statement, like nothing came to our attention and you can, and agreed upon procedures provide no assurance. The practitioner only performs specific tasks and report the factual results. Reasonable assurance is the highest level, but it's not absolutely certainty. There are 11 AICP attestation standards which guide how practitioners should plan, perform, and report on these engagements. In contrast, the GRI Disclosures 156 focuses on what assurance information must be communicated, such as independence, competence, methods used, and a public assurance statement. In summary, AICPA standards define the process, while the GRI standards define what must be disclosed to build the user confidence in sustainability reporting. With that overview of how GRI standards work and how assurance aligns with sustainability reporting, I will now hand it over to my team members who will take you through the ISAE 3000 and its application to sustainability assurance. Thank you.
3000 is the global standard we use when we provide assurance on anything other than financial statement, such as sustainability reports, ESG metrics, greenhouse gas disclosure, and other non-financial information. It's principle-based, which makes it flexible for different types of sustainability engagement. It also allows two levels of assurance. Number one, reasonable assurance, which is more in depth, and limited assurance, which provides moderate confidence. This is the main framework accountants use internationally for sustainability assurance. Even though ISAE 3000 is an international standard, it shares a lot with the AICPA attestation standards. Both require independence, proper evidence, and clear assurance conclusion. The difference is really in their structure. ISAE 3000 is broader and more principle-based, which fits global sustainability work. The AICPA standards are more prescriptive and more tied to US GAAP. So in practice, if a company has international operation or reports using ESG framework, ISAE 3000 is usually the better fit. GRI 102-56 sets out 7 elements that must be disclosed when an organization gets assurance on its sustainability report. Things like independence, scope, criteria used, limitation, and the level of assurance. ISAE 3000 aligns perfectly with all 7. That's one reason it is so widely used globally. It meets every GRI requirement for transparency and credibility. So if a company wants its sustainability report to follow GRI standards, ISAE 3000 is one of the most appropriate assurance framework to use.
I'll be talking about issuing sustainability reports to external stakeholders. There are both advantages and concerns some companies face when deciding whether to issue a sustainability report to external stakeholders. One major advantage is that sustainability reporting helps a company show transparency. It also communicates how the business manages its environmental, social, and economic performance, which builds trust with investors, regulators, customers, and the public. Many customers now view sustainability reporting as their competitive strategy because it supports cost reduction, improve the risk management, and strengthens the company's reputation. Reporting also pushes some organizations to collect better data, to set their goals clearer, and improve their internal system, which leads to more informed decision making and greater accountability. However, there are also some companies hesitate. Preparing a high quality sustainable requires time, money, and expertise, especially for those organizations that not have a yet stronger data system. There's no single global reporting standards, which leaves some companies unsure whether to disclose, and some management may also worry that sharing some information publicly could highlight weaknesses in their company or lead to criticism. CPA Canada mentioned that many organizations are cautious because of publicly reporting, because it may increase some investigation, and not every company feels to like release reporting at this type of transparency. Some smaller businesses in particular may feel that the benefits do not outweigh the effort, and these factors explains why sustainability reporting continues to grow, but it is still not a universal.
In these sections, I will talk about third-party sustainability assurance and why it plays an increasingly important role in modern reporting. As companies publish more information about their environmental and social performance, stakeholders often question whether this information is trustworthy. Because sustainability reporting is mostly voluntary and not governed by strict rules. Many users want an independent check on the accuracy of what companies disclose. That is where third-party assurance becomes important. Third-party assurance brings several key advantages. First, it helps build credibility for sustainability disclosures. When an independent reviewer verifies that the information is accurate and carefully prepared, stakeholders gain more confidence in what the company reports. This improved trust strengthens the company's reputation and can also support better relationships with investors and customers. Another important advantage is the improvement of internal processes. When a business prepares for assurance, it is encouraged to strengthen documentation, improve its data collection methods, and increase oversight of social and environmental measures. Through this process, companies often identify risks, weaknesses, or gaps in their reporting systems. As a result, they can set clear long-term sustainability goals and improve their overall performance. These improvements can also contribute to cost savings, stronger customer loyalty, and higher employment engagement, which the case highlights as meaningful outcomes of sustainability efforts. Although the benefits are significant, many organizations remain hesitant to obtain third-party assurance. One major reason is cost. Assurance requires time, expertise, and internal coordination, and not all companies have the resources to support it. In addition, many organizations do not have strong systems for collecting reliable non-financial data, which makes the assurance process difficult to complete. Another challenge is the absence of a single global standard for sustainability reporting. Assurance providers often have to work with multiple frameworks, which reduce the level of certainty they can provide. Some companies also worry that assurance may reveal errors, inconsistencies, or weak practice that could negatively affect their reputation. Accountants who perform sustainability assurance also face challenge. They need knowledge of environmental and social topics, and they must evaluate many different types of data that are often qualitative and less structured than financial information. They also need to apply assurance principles to areas that do not follow consistent reporting rules. These issues make sustainability assurance a complex and continually evolving area of practice.
In this slide, it will be comparing sustainability assurance providers. There are several reasons for this why accounting firms have a strong assurance expertise. It including the evaluating controls, gathering experience, and applying consistency standards to non-financial information. Their independence and professional reputation often increase stakeholders' confidence, especially for investors and regulators who often rely on reliability and credibility. Since accounting already understands how sustainability connects to financial performance, they can also help present ESG information in a way that aligns with a long-term business strategy and value the creation. On the other hand, engineering and consulting firms can also bring important advantages. On these firms, often they offer a deeper technical knowledge in areas such like emission measurement on environmental science and energy use. They're they specialize their Specialized expertise helps ensures that environmental data, models, and the calculations are scientifically accurate and practical for operations. Managers may also feel more comfortable discussing complex environmental issues with technical experts who understands the underlying science. For this reason, many companies benefit from the strength from both groups. Accounting firms contribute audit level, credibility, and structure, while engineering or consulting firms offer a technical insight and operational understanding. Together, they can help strengthen the overall quality of sustainability assurance.
Caterpillar sustainability really focuses on the environmental and operational impact of its product. They're in industry like mining and construction, which have a big carbon footprint. Their sustainability reports highlight emissions reduction, energy efficiency, innovation around lower carbon technology, supply chain responsibility, and workforce safety. These are not just PR, they directly affect Caterpillar competitiveness and regulatory compliance. So they're central to the company's long-term strategy. What's interesting is that their sustainability report and the 10K actually tell a very consistent story. In the 10K, Caterpillar focuses on innovation, operational efficiency, risk management, and regulatory pressures. And these same themes show up in their sustainability strategy. So the sustainability report isn't separate from the business strategy. It supports the financial priorities by reducing environmental risk, improving efficiency, and positioning the company for long-term growth in a lower carbon future. When you put the sustainability report and the 10K together, it becomes clear that sustainability is embedded across Caterpillar's management processes. From finance that deals with climate risk and regulatory compliance, down to HR, with drive safety culture and workforce development. Purchasing that enforces sustainability in the supply chain, and operational focus on emission targets and equipment lifecycle improvements. So really overall, sustainability isn't a side activity, it is woven into how Caterpillar runs the business.
Next part, I will explain integrated reporting and highlight its key advantages and challenges. This approach is becoming more common as companies try to communicate their overall performance more clearly. Integrated reporting is a method that combines financial and sustainability information into one single report. Instead of issuing a separate financial report and a separate sustainability report, the organization presents its economic, social, and environmental performance together. The goal is to give stakeholders a clear and complete view of how the organization creates value over time. Now I will briefly walk through the key advantages and challenge of integrated reporting. On the advantage side, integrated reporting combines financial information and sustainability information in one clear report. This helps stakeholders see how strategy, risks, and long-term sustainability factors influence the organization's overall performance. Because everything is presented together, investors can make more informed decisions and understand how the company creates value over time. Another important advantage is that integrated reporting encourages integrated thinking within the organization. Management is required to consider how financial and non-financial activities interact, which often leads to better planning, improved governance, and more effective resource allocation. Finally, using one combined report reduces duplication and makes the reporting process more efficient. However, there are also challenges. Integrated reporting requires reliable system for collecting high-quality environmental and social data, and many organizations still do not have strong processes for measuring non-financial performance. Another challenge is that a single report must satisfy users with different information needs. Some readers want concise financial results, while others expect detailed sustainability information, which can make the report feel overwhelming. A further difficulty is external assurance. Sustainability metrics are not standardized to the same extent as financial information, so verifying them is more complex and less consistent. So for the overall, while integrated reporting offers a clearer and more connected view of performance, it requires careful preparation and strong data capability to be effective.